We're finally seeing some green over the past couple days after a brutal January with all the news and fear around the Fed, the taper, the interest rates. I'm going to be talking about what I've been doing in the portfolio as well as what I think is going to be happening going forward. If you've been living under a rock, all the news, all the focus has been on our boy Jerome Powell and the Fed and exactly what they're going to be doing with the easy monetary policy, because over the past couple months we've seen a big rotation from growth to value over the concerns of an increase in rates, which isn't necessarily good for growth. With this meeting, I think the markets were looking for a bit of clarity when it comes to the number of hikes as well as the basis points that those hikes would be. What we got out of the Fed was more lawyer wishy-washy talk about no specifics, but yes, the rate hikes are probably going to be coming and the easy money will probably be going away. I mean, if you were paying attention to the indexes last week, we had some major intraday moves. You were probably having some heart palpitations because we had massive swings. We're talking about minus 5% to break even. Then one day we're up 3%. The Fed starts talking, Jerome Powell opens his mouth, and boom, we go from plus 3 to minus 1%. I mean, the volatility definitely picked up. And what I saw was a lot of bearish sentiment on social media around, it's the end of the world, taper tantrum, everything like that. And what's interesting is when the VIX spikes, I tend to get more excited about buying versus most people that are then considering, oh, how do I hedge the market? If we look at the volatility index over the past few months, these spikes above 30 tend to be pretty short-lived. The difference between these short spikes in volatility versus a huge issue like the pandemic around the start of it, the financial crisis, the tech bubble, those are different situations. And people tend to throw out massive crashes, 40% or something like that, some crazy number, when we get these little spikes in volatility because everyone's afraid, there's uncertainty. Unfortunately, with the Fed, they didn't give us the specific clarity, but there was a lot of fear in the market. Usually, when you're looking at a long-term perspective, investing during these volatile times pays off, if we're talking about index investing. Pair that with a technical level of oversold on something like the Qs, aka the NASDAQ, it looks like we have a bit of a short-term bottom. Are we out of the woods completely? No, I don't think so, because with the taper tantrum that we're seeing, these fears around the rate hikes, yes, there are specific companies that I think are way more fairly valued right now, but there may be some more pain for growth until we get more clarity around the specifics of that interest rate. What does that mean exactly? If we're making short-term predictions, that means that the max pain that I see on these bigger indexes is something like 20%, because if we look at the overall indexes themselves with their earnings, the multiples that they're trading at, it really isn't that insane. If you look at the forward P of something like the S&P 500, it's slightly below 20, which if you look at the past history, yes, that does seem elevated, but there is one difference between now versus the earlier 2000s, and that is the weighting of big tech. It's become a bigger and bigger portion of the S&P 500. The growth of these companies are actually faster. So maybe if we look at something like the PEG ratio, actually the valuations aren't insane. PEG ratio factors in the future growth over the next 5 years. And when you look at this, all of a sudden the earnings paired with the earnings growth, now it's something below 1, and companies are looking pretty reasonable for where they're at. Calling out that we're in some mega crash situation, I think is a bit ridiculous. With that said, I think we get a bit of a bounce in something like the NASDAQ closer to this 370 level, and then we might have another sell-off up until we get more clarity around the interest rate hikes and the severity of those hikes, whether it's going to be gradual or not. It's very similar to 2018. There's a taper tantrum. In that situation, guess what? We recovered. If you are looking for an updated pulse on my thoughts around the markets each week, I have a weekly free newsletter that I send out. Also, if you do sign up, you get an Investing 101 cheat sheet sent to your email. Switching gears a bit and talking about what I've been doing in the portfolio, mostly buying. I've been buying companies like Target, Caterpillar, UNP. Other companies I've been buying is Digital Turbine on major weakness across these small growth companies. And then also picking up companies that are big tech related. So these companies have great cash flow. They have great earnings growth. So Amazon and Google, which we already saw with companies like Apple and Microsoft, who came out with their latest earnings and absolutely crushed expectations. As for selling, there's only one position that I ended up selling, and that was Activision Blizzard with the news that Microsoft was going to acquire them. It was a longer term position, and I finally got out of it on the open of that day that it was announced. It was trading around 86, and I decided just to sell everything then. It's trading closer now to 79. And the reason I did that is the deal I knew was probably going to take a while, and while the valuation or the offer per share was around $95, I didn't want to wait a year and a half in order to get 10%. It's not a lot of gain, and if the deal falls through, then Activision falls. So I decided just to sell it right away and lock in those long-term gains. Plus, then I had a little bit more cash on the sell-off to buy into these stocks that have come down a bit. The overall portfolio is currently 57,255, which has been tracking pretty closely with the indexes, a bit lower than last month, but overall, I'm setting up these positions that I really like for the long term, especially nibbling into some of these smaller mid-cap growth companies that have been really hammered. In terms of asset allocation, you see that 3.1% is around cash, but I did make some buys today in companies like Pfizer, bought a little bit more Google, and then ended up buying a little bit more Etsy. The big thing I want to point out is this percentage breakdown between slow growers, stalwarts, fast growers. We've transitioned the portfolio kind of where I've been wanting to get it to, where fast growers is a little bit closer to 30% in this environment. And if growth continues to get hammered and this falls below 30%, that's where I would start to focus a little bit more on adding these types of companies to the portfolio. And over the long term, we're talking 20 years, growth is where it's at, especially if you can pick up companies at reasonable valuations. So what to expect going forward? More volatility. I expect these spikes in the VIX to happen once in a while, especially around these big Fed decisions. You know, these are basically like Apple iPhone events at this point, and there's so much attention on what's going on with that, as it does affect the economy, inflation, and even crypto markets, because everything has kind of become correlated a bit until we get clarity. And I expect the big boys, the hedge funds, to really push this narrative of fear. That way they can pick up these companies that actually aren't trading at crazy multiples and get great deals. I think we're okay. Growing economy. I'm optimistic. If you guys did enjoy the video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk stocks, investing, anything to do with money. Thanks guys for watching, and have a great day.